Obviously, the jobs report that came out, I mean, it's slightly ironic that it's the one thing, perhaps, which Trump would have wanted to persuade Powell that he should cut rates, and he goes and sacks the chief statistician. I mean, talk about shooting the messenger. It's, this is crazy, absolutely crazy. But it is essentially become very, very political. I think if I was in Powell's shoes, I would be worried about signs of inflation. They're not going lower. If anything, they're tending to drift higher, measured in dollars. And that is even before there's any real impact from all this messing around with tariffs. And I just think that, if I was in Powell's position, I would not cut interest rates. But I think those job figures actually makes that policy almost untenable. Again, if I was in his shoes, I'd probably go a quarter point cut and just get the message over that it's okay, it's a quarter point now, but that's it for the foreseeable future. So I think that's what we're going to get. As to how gold is behaving, I think, Kai, we have to appreciate that, we're in this sort of summer lull. I mean, people are on the beaches or they're with their kids who are on holiday or whatever. This always happens, actually, every summer. Things quieten down in the summer, which I think actually says it all. So nobody's really sitting there and thinking too hard about the implications of what's going on. I guess then in the coming weeks, I mean, particularly in early September, this is what usually happens. In early September, people return from their holidays, investment managers begin to have the committee meetings and all the rest of it. And, the investment strategists in these big firms considering the position seriously. And then you find that investment decisions begin to be taken. Ahead of that, I would expect to see things begin to discount what's likely to happen, if you like, in that sense. And on that basis, I would expect gold to move higher. I don't think I would tie gold in too closely with the interest rate story, other than a cut in interest rates, because what we're looking at is not gold going up so much, we're looking at the dollar going down. And there's no doubt, if you look at the dollar's trade-weighted index on the chart, it's a pretty bearish scene. So I think it's really how the dollar behaves, if you like, over this, that's going to determine the outlook for gold. And as far as the investment strategists are concerned, when they start to look at this, worries of stagflation, I think, are going to mount and mount and mount. We've known, for goodness sake, that the US economy is not growing. I mean, if you take out the budget deficit out of GDP, you end up with the private sector, plus obviously government spending, but funded government spending, actually contracting. And it's been like that for the last couple of years. So there's no way the US economy has been growing. And I just don't see that changing. We've got no growth, in fact, negative growth, if you like, in terms of the private sector, taking that deficit, the budget deficit out of it. No, I mean, so it's a very distorted picture. I see no reason at all why you should not get out of credit and get into real money, which is gold. And I think people will increasingly take that view over the rest of the year. And not only that, but the conditions that we have today are, if you like, a complete replica of 1929. You've got a credit bubble. And the thing about a credit bubble is we all love it. We all think this is wonderful. We all think we're getting it right. We're making money and all the rest of it. Without realizing that actually what's happening is that credit is being funneled into financial assets, keeping them buoyed up. And it's a credit bubble. And then taking the 1929 example even further, we had Smoot-Hawley Tariff Act 1930 beginning to be discussed in Congress in 1929 before it was enacted in 1930. And what have we got today? We have got an even larger credit bubble. And at the same time, we've got Smoot-Hawley Mark II with a capricious president running around saying this is the most beautiful thing I've ever done. Make America great again, shut everybody else down. But he is destroying the US economy. I mean, can't someone just grab him and tell him what the hell he's doing? And that 1929 thing should be taken very seriously because, that combination is catastrophic for portfolios. It's catastrophic for wealth, for personal wealth. I don't think we're in the situation really where, with the economy tanking, with, an asset bubble about to burst, with all these tariffs disrupting everything. I mean, not just America, but globally. The crisis in the dollar. I mean, the foreigners own about $40 trillion and underlying financial assets. Are they going to hang around in a bear market? No, I don't think they will. This is not good. So where do you get out? I mean, basically, you do what you can to try and preserve your wealth, not increase it, preserve it. And the only way you do that is get into real legal money without counterparty risk, corporeal money. which is gold. No, I mean, the problem, I think, Kai, is that the average portfolio manager has been taught Keynesian economics, which is a load of rubbish. He's got to get a bit more fundamental about what's going on. And I mean, all we have got, and this is the importance of selling in May and going away. You don't necessarily sell things, but basically, you just basically, freeze what you've got. You freeze what you've got on the basis that you think it's going to be safe for 2 or 3 months while you go on holiday and play around with, I don't know, whatever you do. And when you come back, you consider it seriously. So, I mean, this drift back in bond yields, I think, is quite normal under these circumstances. And this is why I think when people return and they actually look at the situation, begin to understand that you've got this awful combination of a gathering recession and rising prices, then they can see that the purchasing power of their currency is deteriorating. And not only that, the policy will make it deteriorate even more rapidly. So I would expect to see bond yields begin to rise in the autumn, and I think they will rise very, very sharply. It's been going, well, almost exactly 54 years to the day. So that's a pretty good run, I think, as the fiat currency system. It destroys all our wealth. I mean, we think we're wealthy because we've got more dollars, more pounds, more euros, whatever, but they buy less. I mean, they really do. I mean, look at the dollar. I mean, that was 35 to the ounce, and now we're nearly 100 times that, which means that a 19 measured in gold, which, as I say, is real money, and I must emphasize, we're talking about the difference between real money and credit. Measured in gold, basically, the dollar has lost 99% of its value. Are we 99% richer? We may be sort of somewhere towards it in dollars if we've been very clever in managing our portfolios. But very few of us will have made over, nearly 100 times our money, if you like, over that period. It hasn't increased so much about economic activity. It's more because of the loss of the purchasing power of the currency. I mean, you can't really make long-term comparisons without taking that into account, and nobody does.
No.
But it's not good. No, it really is not good. And I think, as I say, I think you should note, and your viewers should note, that we're coming to the end of the fiat currency system, and then ask ourselves, how do we evolve from that towards sound money? And the answer is it's extremely difficult, because all the malinvestments and all the rest of it have got to be dealt with. And I think initially, the way they're dealt with is by further debasement of the currencies. It's the only way it can be done.
I was just reading in the UK, I think they need to raise, or the UK needs to raise $50 billion more in tax, or pounds in taxes, just to house. I think it came out today or so. That's not feasible. How is that possible to do?
Well, of course, I mean, we are in the same bind as virtually all the other G7. Raising taxes basically is producing diminishing returns. I mean, socialists don't believe in the Laffer curve, but I think they're finding out the hard way that it actually does exist. All our millionaires and billionaires, we've got a huge number of them, are all disappearing to Dubai and Milan and wherever. And I mean, we are very reliant on the rich, basically, to pay taxes. I mean, it's one of the most common stats being bandied around is that the top 1% of earners in the UK pay 30% of the income tax. And the other thing they're doing is they're changing their habits so they don't have to pay so much tax. I mean, there's the idea that the gap is 50 billion, I think, could turn out to be an underestimate, if you like. The problem that the Chancellor faces is that she can't cut welfare costs. I mean, the Parliamentary Labour Party is elected to protect welfare and increase the amount of welfare. And a large portion of the opposition on the Conservative benches also take the same view. We're here to improve things for our constituents. What are our constituents' problems? Well, they're being squeezed because their pounds buy less and all the rest of it, and their welfare payments don't go up, and so we need higher pensions, we need this, we need that. I mean, it's all what a member of Parliament is now elected to do. So when the government of the day faces reality and finds, oh dear, we have got to cut spending, it's chucked out of Parliament. They can't do it. And then you've got Keir Starmer running around and saying we're going to spend another 5% of GDP over the next 4 years or something on defence because of those nasty Ruskies. I mean, where's he going to come from? Out of thin air. Look, these governments, they all have the same problem. And this is why I say this is the end of the fiat currency system. It's coming to an end, and it's going to be very painful for those who have relied on it. Well, I mean, the markets are bemused. I think as far as the Chinese are concerned, they know that they can't rely on America. They know that Trump says one thing one day and another thing the next day. So the idea that the deadline and forget it. I mean, as far as the Chinese are concerned, this is just a whole load of nonsense. And so they're planning to go ahead without America. And they can. They've got the Shanghai Cooperation Organization, which basically is the majority of Asia. They've also got their ASEAN partners, all around them in that part of Asia, sort of Thailand and Malaysia and Indonesia and all the rest of it, all those nations, which have big Chinese diaspora and therefore are sympathetic to trading relations. They will also, in my view, bring in South Korea and also Japan. What's called the global South, the ones who at the moment are frightened of America, but want to join BRICS as soon as they see American power diminish a bit. I mean, the world is splitting into two. And, we, as American allies, are in the minority. And here we are trying to push the majority around. What happens is they say, well, we don't need you. And I think that is what's going to happen. So, I mean, this is another thing. Once markets begin to realize this, then, capital reallocation, the reallocation of global capital is going to become a major issue for America. In the past, they've dealt with it. If you like, calling them out as being, ruthless against Uyghurs and all this sort of stuff. And they tried, according to one of the heads of intelligence, of army intelligence in China, and this is publicly reported, they reckon that the Americans were behind the 2014 Hong Kong student riots. Why? They've been trying to destabilize China. I mean, attacking Huawei was another, quite simple American operation. Every time the Americans try and do something, I mean, I have this image of President Xi, who doesn't give anything away. He just sort of stands there, smiles slightly like that. It's Sun Tzu, if you like. This guy knows what he's doing. And you have Trump running around like a stampeding herd of elephants in the global economy, thinking that he's doing good for America. No, he's not. He's killing America.
So Alasdair, based on what you've mentioned, like what is priced into the gold price right now, which takes us a bit to the geopolitical discussion. Like, how geopolitical is the gold price right now? Can you elaborate on that?
Yeah, well, it is obviously geopolitical because if nothing else, central banks have been accumulating it. They have, in effect, they've been selling dollars and getting into real money. So, yeah, it is geopolitical. We know, at least I know, they can go onto the gold standard to protect their own currencies from the end of the fiat currency era. So, yeah, I mean, I think this is the background for gold. I mean, looking at it, gold has risen more than quite a lot of the things that you would expect to rise over time with it. I did an analysis a little while ago of pricing base metals in gold, and I found that from the prices in the year 1900, so we're going back 125 years, gold is now less than 20%, sorry, not gold, base metals, a basket of base metals is now less than 20% of the values at that time. 80% discount, if you like, in terms of value is an accurate measure of anything. What we can say is that gold is ahead of the game relative to precious metals. And I suspect that's also the case with other commodities. I think this tells us two things. It tells us that a lot of commodities have been left behind. So I think that's the first implication. The second implication is that gold itself, in terms of its own value, may well be getting a little bit ahead of the commodity game. So it's not just commodities being undervalued, but perhaps gold being slightly overvalued. I would expect to see that measured in fiat currencies. So yes, gold, I think, is a little bit ahead of the game, if you like. But then it is, in terms of its value relative to fiat currencies, it's bound to reflect the prospects for fiat currencies. So I think it's quite reasonable to suggest that the current level is fine in that context. And maybe, and the interesting thing is, if you look at the technical position in the market, we're just completing what Edwards and McGee, the people who wrote the definitive work on Dow theory all those years ago, call a pennant. And the point about a pennant is that the move in gives you a forecast for the move out once you break out on the upside of the pennant. And so we're looking at adding probably a minimum of $900 once gold breaks 3,440, which is not too far above the current level. Once it breaks up above that, we could run another $900 to 4,400-ish, let's say, in a similar space of time, that the move in took, which takes us to that level at the end of this year. A developing problem in fiat currencies. And I can see exactly what that is. The asset bubble popping. I mean, just imagine what happens when asset bubbles pop. I mean, basically, all the collateral held by banks against their loans. And if you look at the margin loans in the system supporting financial asset prices, and particularly stock market prices, that's gone over $1 trillion now. That is at an all-time record. So, I mean, this is a bubble which, when it pops, is going to create an awful lot of collateral damage. And what does the Fed do in that case, the Fed and the Treasury? Well, basically, they start rescuing zombies. So, with that sort of trouble in store, I can see gold going up to $4,500 quite easily by the end of this year. But I mean, it is reliant on those things developing. But, any financial historian can see the prospects of that developing if they really look for it. And again, I go back to 1929, credit bubble plus Smoot-Hawley Tariff Act, Mark II this time. And, Trump's tariffs are even more destabilizing than Smoot-Hawley was, by a long shot.